Hi everyone, and welcome to Week 1, Introduction to Financial Statement Analysis. I'd like to, just before we start our Week 1 topic, just to remind you to please watch the video that I've put above this recording on iLearn in the Unit Information and Resources section, because that introductory video introduces you to the structure of the unit and also how we're going to use iLearn. So please watch that before you watch this Week 1 video. All right, so we're looking this week at these various aspects of financial statement analysis. So we're starting to become familiar with the balance sheet, the income statement, and the cash flow statement. That will be our main focus as we go on and do some modelling. We're also getting a brief introduction to a fourth financial statement, which is the statement of changes in equity. And then we're moving into some other aspects of financial reporting and then thinking about the accounting regulation and the framework, as well as different types of business structure as well. Now, if we were in the classroom, I would be taking some time throughout the lecture to allow you to look at financial statements yourselves. But because we are conducting this unit online, this session, I'm going to go through the material in this recording, and you can pause wherever you like. So that would help you to reflect on the content, but also potentially to do your own reading, to make notes, to practice the other tasks that are on iLearn, and then to come back. So there's no need to rush through this whole recording from beginning to end. Take your time, pause it where necessary, and come back to it. All right, so let's first of all look at this introduction. Now, as I mentioned, there are 4 statements that we will be focusing on. We are going to be mainly focusing on the first 3. The statement of changes in equity is really showing us the link between the balance sheet and income statement. It's really a byproduct of those reports. So it's not really going to be used in our modelling later on. So the focus is on the first 3 there. And if we think about who's interested in these statements, you can see that there are various groups, and this is not an exhaustive list. There are other users as well, but the main ones that we are particularly interested in are firstly the managers, and we often call them the internal users. So they would be using these statements for decision making. So they might, for example, be thinking about decisions regarding the operations of the firm, so working capital decisions, right? How will we manage our cash and our inventory and our accounts receivable? It helps them to make investment decisions. Okay, so what sorts of projects or long-term assets may we invest in? It helps them to make decisions about the level of debt, right, in the business. Is it too high or is it too low? And also, when we think about management accounting, there are lots of everyday decisions regarding cost management or cost control or product mix decisions. So a lot of different decisions that will be made by managers based on these financial statements. And you may very well find yourselves in that position of making those decisions later or advising managers in making those decisions. We can also think about investors and potential investors. So they are certainly interested in whether the company is doing well. Is it going to provide them with a good return on their investment? Creditors, so these are the outside entities. The business will owe money to the creditors. So this could be, for example, if the company is applying for a bank loan, then the type of information that the bank would require would be on these main financial statements. So there might be large creditors, so this might be a bank for a bank loan, or there may be small creditors like suppliers, right? The suppliers would be interested in whether this business has the ability to pay what it owes. And also there are financial analysts, and you may very well be in this role later on. So if it's a listed company, then the role of the financial analyst is to provide information to investors and to make a recommendation for investment. So all of these different groups are interested in these statements. So let's have a look at each of these statements in turn, starting with the balance sheet. Now, in the balance sheet, we have three main sections, right? We have assets, liabilities, and owner's equity. So assets are those resources that the business has that have some future value. So we're thinking about things here like cash, inventory, property, plant and equipment, right? So these are items that the business controls and have a future value. And then we're thinking about how are those assets funded? So where would we get the funding for those assets? Well, we may have liabilities, which are external parties that the business owes money to, right? So these are borrowings, if you like, and owner's equity, which is the owner's investment in the business. Now, what we should be able to see here is that the assets of $1 million here is equal to the liabilities plus the owner's equity. And that's what we call our accounting equation. They must be equal, and we must always ensure that that accounting equation is equal. So what we own is equal to the financing of those assets. So you can see this written in two different formats here. So when we're looking at the assets on one side and the liabilities and the owner's equity on the other side, that's a nice illustration of the accounting equation. And often we would call that the T format or T account format for a balance sheet. It's like a T with two sides. But you can see the same information below. Our assets equal our liabilities plus owner's equity. So that is a vertical format. And this format is what we're more likely to see in the annual report of a company. And I am going to be going through the annual report of Woolworths with you later on in this lecture, just to show you how their balance sheet appears. Now, when we come to week 3, we're going to be looking at different transactions that a business might have. And we'll see that when a business has a transaction, like it sells goods to customers, for example, that when we record that, it must affect both sides of the equation, right? So if it's affecting assets, it must also affect something on the other side of the equation. Or if one asset goes up, another asset must come down. So we will be keeping in our minds the importance of always keeping the equation equal. So assets equals liabilities plus owner's equity. So we'll see that much more as we go on, especially in week 3. All right, now let's look at some subcategories of these assets and liabilities. So, and notice also that the balance sheet is also called a statement of financial position. So you'll see either of those names in a company's reports. So first of all, thinking about the assets. So assets can be separated into current and non-current. And you can see that's the same with liabilities as well. So when we're talking about current, we're actually talking about a time period. So current assets are those assets that are expected to be turned into cash or used within 1 year. So this would include cash, it would include inventory or stock, because that's something that we would usually be selling within 1 year. Right, and we'll look at an example in a moment, but they will be listed in order of their liquidity. So that means how quickly they can be converted into cash. So I'll point that out again in a moment. When we think about current liabilities, and remember these are obligations to an external party. So if it's due within 1 year, we call it current. And then we think about non-current. So non-current or long-term assets or fixed assets are expected to be converted to cash in a period longer than 1 year. So this might include things like equipment or buildings. Okay, they're going to last for longer than a year. And non-current or long-term liabilities are obligations beyond 1 year. So this, for example, could be a bank loan. All right, so let's have a look at an example of a balance sheet here. So you can see here we might have some current assets and they've all been grouped together. We'll have a look at some examples of that in a moment, followed by long-term assets, which might include investments, property, plant and equipment. Now, property, plant and equipment would include things like buildings, vehicles, equipment, as it says here. Plant, in accounting, we use that term to mean a factory, right? Usually. Okay, so that includes all of those, usually grouped together. There might be natural resources, if it's a mining company, for example, or if it's a farm. And intangible assets. Now, intangible assets we'll talk about in more detail later, but intangible assets are those assets that don't have physical properties. So you can't see them, you can't touch them, but they are things that have value. And we'll look at some examples of those a little bit later. So you can see we can total up all of those assets. Now you can see that we're using 2 columns here, which is often done, for management decision making, because we can see we've used the first column to show all the detail, and then the second column shows the main totals. So all of those add up to $1 million there. Then we can list the liabilities and owner's equity here. So we've got some current liabilities and some long-term liabilities. We'll add those up and that gives us total liabilities. And then we have our owner's equity. So we add the liabilities and owner's equity and that equals the assets. Right, so the balancing is important here, and as we get into our modelling later on, that's something that we always need to make sure of, as we said. Now, something else to notice about the balance sheet is what's written at the top. So we have a title, and normally we would have the name of the company and the name of the statement, which is the balance sheet, and it is normally as at a particular date. So it's showing us what is the financial position at one point in time. It's like getting your camera out and taking a snapshot of the business on one particular day. All right, so as I said, we're going to look at a more detailed balance sheet for Woolworths towards the end of this lecture. All right, now just to break this down a little bit, so what we just saw was all of the current assets lumped together on this balance sheet. So what might be included in there? Well, as we said, cash is one of the important current assets. And remember, these are all assets that are likely to be used up or converted to cash within 12 months. So cash, short-term investments, accounts receivable. Sometimes these are called trade receivables. So these are the customers who owe the business money. So that's something that has a future value for the business. We have notes receivable, right? So these would be investments that are likely to be received within 12 months. We'll talk about accruals later on in week 3. Right, so we won't worry about those too much for now, but these are amounts that we are likely to receive in the future. Inventory is often a big current asset for a retailer. If it's not a retailer, if it's a service business, you might not see inventories. Another word for inventory is stock. And prepaid expenses. So if, for example, this company has prepaid their rent, so paid their rent in advance or paid their insurance policy in advance, then this is something that has future value. So we would be including that here. And so we can see that we total that up, that gives us 300,000. And if I just go back to the previous slide, you can see that matches the 300,000 here. All right, now what about long-term or non-current assets? We said that one good example of that is property, plant and equipment. And as I mentioned, that could include land, buildings, machinery and equipment, furniture and fixtures. So if it was Woolworths, for example, as a company, that would include all the shelving that they use. That's what we mean by fixtures, or the cash register counters and so on. There could be construction in progress, right? So maybe there's something that is only partly finished, maybe a building or an office. And we'd add all of that together, and that would give us the property, plant and equipment there. Actually, just something, I might just go back to the current assets, because there was a point that we made earlier that notice the current assets are in order of liquidity. So the ones that, and liquidity is all about how quickly it can be converted to cash. So remember, cash is cash, and then our short-term investments could be converted to cash immediately if we needed to. Same with our accounts receivable. We could sell them to a financial institution if we needed the cash straight away, right? Whereas inventory would normally be a bit lower in the list because it often is a bit slower to sell. All right, whereas with property, plant and equipment, this is not about liquidity, right? Because we're not planning on converting them to cash. We're planning on using those in our business. All right, now we mentioned intangible assets earlier, and here are some great examples. So patent, right? So that's where we are protecting our own invention here. Okay, so normally, and this would depend on local regulations, whichever country we're looking at, but 20 years in Australia. So that would protect your invention from being used by someone else. And so that's valuable. A copyright, so that protects something that is in writing or something musical, so some kind of creation. And so that protects it for the life of the creator plus 70 years. So that's something valuable. Trademarks and trade names, licenses and franchises. Goodwill is usually a really important intangible asset. So goodwill is where we may have purchased another business and we've paid more for that business than its balance sheet is worth. Right? So if we look at its balance sheet, normally we'd be paying the difference between the assets and the liabilities for a business. But if we pay more than that, it's because we're paying extra for maybe things of value that are not on the balance sheet. So for example, if the company we've purchased has a great location, or if it has a really great pool of loyal customers, or it has really skilled managers, or there are things that normally we couldn't put a dollar amount on. If we pay something for them, now it has a monetary value. So goodwill, when you see that on the balance sheet, that is all to do with paying for a business acquisition. Okay, and that's what that description is all about there. Right now, we're not going to be looking at the actual valuation of intangible assets because it can be quite complex. The intangible assets have to be tested for impairment every year to see whether the original value we've recorded is actually still valid. So we may have paid for the great location of a business, but maybe it turns out later that it wasn't so valuable after all. So there's quite a complicated process in revaluing these year after year. We're not going to go into that. But what you do need to understand about intangible assets is the concept, right? What they are and why we have them. And also, to know some examples of intangible assets. That's really all we're expecting you to know about those. Okay, current liabilities. So remember, these are the ones that need to be settled within 12 months, and we have quite a few examples here. So accounts payable are usually our suppliers of our inventory. So we owe, in this case, $81,000 to the suppliers. Notes payable, so we may have raised some funds by selling notes and we now need to pay them. Maybe warranty that we may have to pay in the next 12 months. Unearned revenue. So potentially our customers have paid us in advance for something. So it might be if we are a magazine publisher, for example, we may have received an annual subscription from our customers, but we haven't provided the goods yet. So we owe them these goods. Or we may, if it's a gym, for gym membership, we owe them a service. So that would be unearned revenue. Or we may have accrued liabilities. And again, we'll look at these in more detail in week 3. So I won't go into too much detail here. So these are all things that are payable. So income taxes payable, dividends payable. So they're all short-term obligations. Now, an interesting one here is the current portion of long-term debt. So normally we would classify long-term debt as a non-current liability, but if we know what portion of that needs to be paid this year in the next 12 months, then we will separate that out. All right, so we're separating the current portion. So often with a long-term loan from a bank, for example, we'd normally pay that monthly, and each payment is going to be part principal. So part of it is principal, part of it is interest. So those those principal repayments that are due in the next 12 months should be classified here as a current liability, and the remaining portion of the loan would be classified as a non-current liability. All right, so you may very well see that on a company balance sheet. All right, now thinking about the equity section on a balance sheet, if we're thinking about a company structure, then the company has shareholders, that's their owners. And 2 main items that we'll normally see in the equity section for a company are these 2. Now, it is using some US terminology here. So when you're looking at an Australian company, you might see it's slightly different. It's often called shareholders instead of stockholders. And instead of common stock, we would normally call this ordinary shares. Right, so this might be called share capital, right? So that's often a name that you'll see for that. Or contributed equity is another name for this. So this is the original amount of shares that were issued by this company at the original price. So this company obviously issued 40,000 shares some time ago at $2 each. So that gives them a share capital here of 80,000. Now, the other important part of shareholders' equity is retained earnings. So this is the accumulated profit of the business. So each year, the company may be earning profits or it may be incurring losses. And this gets added to or subtracted from the retained earnings. So this gets added to or subtracted from every year according to the profit or loss. And if this company pays dividends to the shareholders, that will be taken out of this retained earnings. So this retained earnings figure gets updated every year. So it will change every year. Whereas the common stock or share capital usually will not change. It won't change unless the company issues more shares or buys back shares. So it hardly ever changes. But we'll add those together, and often as we look at Woolworths later, we'll see that often a third element here in shareholders' equity is reserves. So we'll talk about that later on as well. So if we put all of this together, we can see this example of Global Corporation Proprietary Limited. So we've got the balance sheet. Now, when we're looking at a publicly listed company, this one is not a publicly listed company, and I can tell because it has PTY Ltd here. PTY means proprietary, and that means it's a private company. All right. If it was a publicly listed company, it would only say Ltd or limited. So we have a balance sheet here, and notice that the figures are all in millions. We have 2 years, so we've got comparative figures here, and this is required in the accounting standards. You can see it has listed all the current assets and the long-term or non-current assets here on one side, and then the total assets for the 2 years. Then we have the liabilities and the shareholders' equity. So we've got our current liabilities and our long-term or non-current liabilities. And then we have our shareholders' equity at the end. So we can see that when we add up the total liabilities and shareholders' equity, it equals the total assets for each of those years. And you can see here in the title, there's the 3 elements that I was mentioning earlier: the name of the business, the name of the statement, it's a balance sheet, and the date, right? And it is as at that particular date. So there is a balance sheet. Now let's move into the second really important statement here, and that is the income statement. Now, what we're recognizing here is that the income statement measures the profit for the business. So it has different names. Sometimes we call it the profit and loss statement. Sometimes it's called the statement of financial performance for the business. So we might see different names for it. And the basic idea here is to measure the profit, we're taking the revenue minus the expenses. So the revenue is what the business is earning, right, through providing goods or services. And the expenses are whatever the costs are that are associated with earning that revenue. So expenses are things that we have used up in order to earn that revenue. And what we can see here on this slide is a very simple version of the income statement. So what this statement has done is it has added together all the revenue and added together all the expenses, and then it has subtracted the total expenses from the total revenue to give a net income. Now that's a really simple version of an income statement, and we're calling this a single step statement. Now notice at the top in the title, the name of the company, the name of the statement. This time it's over a period of time. So the balance sheet was on one particular day. The income statement is over a period of time. So we need to see, is it over a year or a month or a week, right? So it's really important to have the details listed there. So you can see this business had sales revenue being its main form of revenue, but also other income as well, which could have been rental income if they're renting out property, or it could be interest income from their investments. So that gives us total revenue. Then there are some expenses. Now, if this is a retailer, so a business that sells goods to their customers, then they're going to have this really important expense here called cost of goods sold. So as the name suggests, this is the cost of the inventory that we have sold to our customers. So we bought it for $500,000 and we sold it for $800,000. Right? So we'll look at that in more detail later on. Then the business might then group together their other expenses into this category here called selling, general and administrative expenses. So this might include things like, so selling expenses would include things like maybe advertising, marketing, maybe delivery to customers, the salespeople's salaries, any of the expenses to do with their shop, right? So that would be selling expenses. General expenses might be things like electricity, rent, all of those kinds of things, water, gas. Administrative expenses are office expenses. So it might be the stationery, it might be the office staff salaries, and so on. So they are all examples of expenses often grouped together. And different businesses might have different categories, right? So we'll see that as we go along, and we'll look at Woolworths later on. And there might be some other expenses as well, and income tax expense if it's a company. Right, so we've totaled all of those up. We've found our net income. And if it's a company, you'll see this as well, the earnings per share. So this would be the net income divided by the number of shares that have been issued. Okay, so yeah, that's the earnings per share. Now, that's a single step statement, which we don't normally see for a big company. It might be okay for maybe a sole trader or a small business, but what we are more likely to see for our purposes is a multi-step statement. So this is where we've got various groupings and several subtotals. All right, so we'll see these in a moment. So these are the kinds of subtotals that we might see. Gross profit, profit before and after tax. There might be comprehensive income net of tax and total comprehensive income. So let's have a look at an example. So we're thinking about a company that sells goods. So in other words, a retailer here. So let's have a look at the top part of the income statement. Here's the sales revenue. Now we're separating this out. So this is the gross sales revenue. And when you see that word gross, it means unadjusted. So this is the sales revenue without adjustments. But there were some adjustments through the period. So some of our customers returned some goods. So we need to subtract that, right, from our sales. And maybe we gave some sales discounts, and this might have been for early payment, right? Maybe we gave an incentive to our customers to pay their invoices early. So these total $100,000. So we need to subtract those from our sales to give us our net sales revenue. So net means adjusted. Then if it's a retailer, as I mentioned, it's going to have cost of goods sold. So we need to know what was the cost of the goods that we sold. We know how much revenue we earned from it, but how do we work out the actual cost of these goods? Now, a lot of businesses are going to have some kind of computer point of sale systems where they can automatically update this as they make their sales, the cost of goods sold. So, for example, if we're looking at Woolworths, they have barcodes and scanners. So if you buy a loaf of bread at Woolworths, and it gets scanned at the checkout, then they have automatically recorded the selling price as well as the cost price of that loaf of bread. So they won't need to make this calculation of cost of goods sold because it will already be updated and they'll have the balance ready at the end of the period. But some businesses might not have that sophisticated system to do that. So normally these kinds of smaller businesses would need to do a physical stock take to work out their cost of goods sold. They need to count their stock. So for this business, they would have counted their stock at the start and they found there was $40,000 worth. Then they would add the cost of the goods that they've purchased throughout the year from their suppliers, and that gives us the cost of goods available for sale. Then they count the inventory again at the end and they find they have $65,000 worth of inventory. So if we subtract that from the goods available for sale, then that gives us what we must have sold. So in this case, 500,000, we subtract that from our revenue, and that gives us what we call our gross profit. So this is really important for management decision making here, because what this is showing is what is the profit that has been made from our primary activity, which is buying and selling goods. So we sold the goods for 800,000. We bought them for 300,000. We bought them for 500,000. So the difference is 300,000. That's the profit we've made before any other expenses from our primary activity of buying and selling goods. And you'll notice that it is important to have that subtotal there because it helps us to do some ratio calculations later to do some analysis of the performance of the business. Right, then after that in the income statement, there will be the operating expenses. Now, we saw before that these could all be grouped together in something called selling general and administrative expenses, for example, right? Or there might be different groupings, but just some examples here of what would be included. So things like salaries, taxes, human resources or employment expenses there. Depreciation. Now, depreciation's an important one. This is trying to calculate how much of our non-current assets we've used up over the period. Right, so that's something we'll look at more later on. Things like rent, utilities are normally electricity, gas, water. We've got supplies that we've used up, uncollectible accounts, or otherwise known as bad debts if our customers don't pay. Various kinds of taxes here, telephone, postage, insurance, repairs, advertising. So all sorts of different expenses that we might come across. All right, so when we have these operating expenses, these are all of the expenses that are not included in cost of goods sold or gross profit. These appear underneath that. Right, so they're related to the business operations, but they're not related directly to the purchasing of inventory. So we break them up separately here. All right, so the gross profit is only the revenue minus the cost of goods sold. When we also subtract the other expenses, right? So if we have a look here at this, putting it all together, we will get the net profit, right? So that's why we're calling this a multi-step approach, because we're getting all these different levels. And this is a much more useful format for analysis than that single step approach that we saw before. So let's just have a closer look at this comprehensive example here. So here's our sales, less our cost of sales gives us gross profit. Subtracting selling, general and administrative expenses. This business has research and development, depreciation and amortization. So depreciation relates to the physical assets. Amortization is the same as depreciation, except it relates to intangible assets. So if we subtract all of these expenses from the gross profit, that's going to give us the operating profit. Now, there might actually be some other income here. And that would then give us our EBIT. Now, this is an important line item here. EBIT stands for earnings before interest and tax. And it's important because it's telling us something about the raw earnings of the firm, right? So it excludes interest and tax, because interest is not related to the performance of the firm. It's related to how much debt or liabilities the firm has chosen, right? And taxes are due to government policy. It's not something that's in the control of the business. So everything above the EBIT is to do with the performance of the firm. So EBIT is something that we use in our analysis later. Then we subtract our interest expense. Often this is net interest, so there might be interest income minus expenses. And that gives us our net profit before tax. Then we calculate our tax, which in Australia would be 30% of the net profit, and that would then give us our net profit after tax. We have our earnings per share. Now, we're mainly interested in the basic earnings per share. So remember, that was the net profit divided by number of shares. The diluted earnings per share, we won't worry too much about, but that's basically if we've issued something like bonds, which are debt to the public, but they are convertible to shares, then this one is saying if the bondholders convert that to shares, what would be the earnings per share? So this is normally a bit lower than the basic earnings per share, but don't worry too much about that. We're not too concerned about that one. All right, so we'll look at Woolworths later at their income statement. We'll see it looks quite similar to this. So just keep in mind this multi-step approach is much more useful for analysis. The single step statement excludes a lot of these line items, so it's not as useful. Let's move into the statement of cash flows here. So we've been looking at the income statement and the balance sheet. They are not based on cash flows, and we'll talk about that more later on when we start analysing transactions in week 3. But this statement of cash flows is based on cash flows. So it's really important to see the cash inflows and the cash outflows for the business. And you can see here that it must have these 3 areas of activity, right? So you can see that we're trying to identify cash flows from operating activities, and the sorts of things you can see here are related to the everyday activities of the business: collecting cash from customers, paying suppliers, paying employees and other operating expenses. And these are related to the items that we see in the income statement, except we're looking at the cash version of those items. Then we have cash flows from investing activities. So this is going to be things like purchasing long-term assets or selling long-term assets or paying for long-term investments, right? Or selling business investments. So these are all about long-term assets, buying and selling them. And then the last part is about financing activities. And this is all about changes in equity and long-term liabilities. So we may have received cash from borrowing, or we might have repaid a loan, or the owner might have invested some cash or taken some cash out of the business. Okay, so these are the three main categories that we see. Now, there's two approaches that could be taken in constructing this statement of cash flows. There's the direct method and the indirect method. And depending on the method that we choose, we're going to have a different approach for this operating activities section. But regardless of the method we use, the investing and financing activities will stay the same. Right? So the only difference is in how we set out the operating activities. So what I'm showing you here, and I think this is not on the slides that you have there on iLearn that you've downloaded. So you might even like to just make a note that on this slide, we're looking at the direct method. So here's an example. So the name of the business, the name of the report, which is the statement of cash flows. And notice that like the income statement, this is over a period of time. All right, so this is the direct method where we find the cash inflows and outflows directly about what was the cash received from customers, what were the cash outflows associated with wages and these other items. Right? So you can see here we have the cash received from customers. We total up all of the outflows, and that gives us our net cash flows from operating activities. And you can see that that's positive because the inflows were more than the outflows. So the direct method means that we are showing each of those cash flows separately. Okay, and we'll see how that differs from the indirect method in a moment. Then here we have investing activities. So this was a purchase of equipment. Notice it's in brackets, and when it's in brackets, it means it's a negative. So this was a cash outflow because when we purchase equipment, it means we've spent some cash. Then we come to financing activities. So we're looking for borrowing or changes in equity here. So we had cash received from borrowing on notes payable. So this company issued some notes to the public, and so it will need to repay that later on. So there's a cash inflow because they received the cash. Then they made some repayments on their notes payable. So that's a cash outflow. And the owner withdrew some cash. So that was a cash outflow. So we add the inflows, subtract the outflows. We've got a net cash outflow here for financing activities. And then we can aggregate these three totals, right? We've got the inflow and two outflows. That gives us a net increase in cash during the year of $780. And then what we can see at the bottom is we're reconciling that with the amount of cash on the balance sheet, right? So we had a cash balance at the start of 1,800, and then we add the increase we've had over the year, and that will give us the bank balance at the end. So something that's important to recognize here is that this must match the balances in the balance sheet. And this is an important check that you're going to be doing when you're modeling later on. that we want to make sure that the cash balance at the beginning matches the balance sheet at January the 1st, 20X1. And the balance at the end should match what's in the balance sheet for December the 31st, 20X1. So when we're modeling later on, there's two main checks that we're going to be doing to make sure that we're being accurate. So firstly, we want to make sure that the balance sheet balances, that our assets equal our liabilities plus our owner's equity. And the second check that we're going to need to do is to make sure that the change in the bank balances on the balance sheet equals the change in the cash flow statement. So in other words, the balance at the beginning and the balance at the end match the respective balance sheets. So I'll show you that again later when we're looking at Woolworths. All right, so that is the direct method. Now we're about to look at the indirect method, and you'll notice the only difference is in how the operating activities are set out. Right, so here's an example of the indirect method. So we still have our same subheadings. We've got the operating activities, we have the investment activities, and we have the financing activities. Okay, and the investment and financing activities are set out the same as we've been looking at. But let's look at the operating activities here. So sometimes, if we're trying to construct this statement, we may not know all of those individual cash inflows and outflows for operating activities. So for example, if we're trying to find the cash received from customers, it might not be obvious because we might have been selling our goods for both cash and on credit to our customers. The customers will pay back what they owe us at some point, but the timing of that might not be known. So I can count all of my cash sales and I will know how much my customers owed me, but I'm not quite sure how much my customers have paid me back this year. So there might have been some bad debts, right, where the customers haven't paid, or they might pay what they owed this year, they might pay that in the following year. Or we might have received some cash at the beginning of the year that related to accounts receivable in the previous year. So the timing might not be obvious, and it might be difficult to find out what exactly was the cash flow for each of these items. Same with payments to suppliers. Right, so we can still construct our cash flow statement even if we don't know what those cash flows were. And we can do it by adjusting the net profit. So you notice what we're starting with here in the indirect method is we start with the figure from the income statement, and then we adjust it for items to try and find the cash flow. Now, this is going to make much more sense later on, so I'm not going to go into a lot of detail here today, but you can see the kinds of things that we're adjusting. So we're adding back depreciation and amortization because they are not cash flows, right? So we're eliminating that from the net profit. Then we're having a look at changes in accounts receivable, accounts payable, and inventory, because that's going to give us some idea of how much was paid back from our accounts receivable, how much did we actually pay our accounts payable, and how much inventory did we purchase for cash. So don't worry too much about the calculations at this stage, because we're going to look at that more in a later lecture. So what you just need to know at the moment is the difference between the direct and the indirect method, right? So in the indirect method, all we've done is adjusted the net profit for changes in the accounts receivable, payable, and inventory, right? And that we get the same value, right? So regardless of whether we've used the indirect or the direct method, we should get exactly the same value for the operating activities. So if we don't know the exact values for the cash flows and the operating activities, we can always prepare the cash flow statement using the indirect method. So more detail on that in a later lecture. So just understand the concept there. All right, so let's see how the statement of cash flows is linked to the balance sheet. So the operating activities, and we just noticed this particularly in the indirect method, we can see that that is linked to certain current assets and current liabilities. So for example, the change in the accounts receivable will tell us how much cash was received from our customers. The change in the accounts payable will tell us what cash did we pay to our suppliers. So there's a very strong link there between the operating activities and the current assets and current liabilities on the balance sheet. The investing activities are related to the long-term assets. So we're focusing there on the sales and the purchases of our long-term assets. And the financing activities are related to the long-term liabilities and shareholders' equity. So did we borrow or make repayments on our bank loan? Did the owners contribute more cash? If it's a company, did we issue shares? Or did we pay dividends to our shareholders? So that would all be classified as financing activities. So we're seeing these strong links here. Now, when we come to modelling and forecasting later on, we have to make sure everything is checked. We have to make sure that our statements are linked. So we're seeing some important links here. So we make sure they're linked in the right way and that all the numbers match up and they make sense. So we need to have a good understanding of how they go together. Now, here's our last one on our list, which is our statement of changes in equity. So as the name suggests, we're looking at what happened during the year to explain the change from the beginning balance of equity and the balance at the end, right? So how did it change and why? So we're looking at increases in equity from profits and decreases from withdrawals or dividends, right? And also contributions by the owner here. So you can see here are our two main types of equity that we looked at before. So we have our beginning balance for these items. So this would come from the balance sheet at the beginning of the period. So notice we're looking at the changes over a year here. So what was the balance at the beginning? And then what happened throughout the year to change them? So common stock or share capital can only be affected by issuing more shares or repurchasing shares. So you can see this company issued some more shares, so they have at the end $100,000. Retained earnings, here's the balance at the beginning. How does that change? Well, remember, this is accumulated profits. So we find the profit from the income statement, we'll add that, and some of it might have been paid out as dividends. So we subtract that, and that gives us our new balance for retained earnings. Then we can add those together, and that would give us our total equity at the end. So this has to match the balance sheet at the beginning and the balance sheet at the end. So there's another link there, and this explains the changes in the equity from one period to the next. So as I said to you earlier, we're not spending a lot of time looking at the statement of changes in equity. It's only this one slide here. The values are coming from other statements, and we're not going to be directly looking at this statement when we're using our modelling techniques later on. All right, so don't worry too much about that. We will be referring back to that later on when we're analysing the statements. All right, so just some additional issues here related to financial reporting. The balance sheet that we've looked at, or the statement of financial position, is fundamental, right? So it's showing us what is the position of the firm at a particular date, all of the assets, liabilities, and owner's equity. Right? Now, what are some links here that we've noticed? The change in the cash balance between the two balance sheets is the cash flow statement. The change in the equity balance between the two balance sheets is the statement of changes in equity. And as we said, that's showing us the change in capital, any dividends that have been paid, and the change in retained earnings. So two big links there that are important. All right, so we're going to look at Woolworths in a moment, where we will see these four statements that we've been looking at. But something else that we see that is equally important is the other information that the company shows us in the annual report. So this is information beyond the financial statements. All right, so we'll see in Woolworths, as I said, in just a moment, but we'll see examples of these notes that come after the financial statements. So these notes will show us what accounting policies have been adopted, right? So for example, how have they measured their inventory, for example, or how have they measured their depreciation? There'll be detail about the numbers in the financial statements. So, for example, if we're looking at the share value, right, maybe the share capital, how many shares were there and what are the details, right? What different kinds of shares are there? There might be details about the property, plant and equipment, right? Or a breakdown of any items that they've grouped together in the financial statements. And there'll also be additional financial and non-financial information. So, for example, there'll be a table that shows the 20 largest shareholders. There'll be a section that introduces the directors on the board of directors, right? So there's a lot of non-financial information in there as well. All right, so we've talked about financial statements, all right? So there's the income statement, balance sheet, statement of cash flows, statement of changes in owner's equity. So that contains information about financial activities and position of the company, and we'll see that in the annual report. But a lot of other very important information is found, as we've said, in the notes to the financial statements, but also in the auditor's report. So the company must have an external auditor come in to check their reports to verify that they're accurate, right? So we'll talk about that more later when we look at Woolworths. And also there will be management discussion and analysis. So that is usually the management's view and opinion of the financial reports. So looking at these in a bit more detail, the notes to the financial statements. So we've got textual and numerical information. It immediately follows the financial statement. So they're like footnotes, if you like. Right, so it explains things like it discloses the accounting methods that we've used, as I mentioned, additional detail and explanation of account balances. When we have a look at Woolworths, you'll see this, but it may, for example, have next to the property, plant and equipment in the balance sheet, there'll be a number. Right, so these items are numbered 1, 2, 3, 4, 5, and then we can look at the footnotes to see more detail. All right. And also, it might provide information not recognized in the financial statements. So, for example, there might be an upcoming court case, and there's potential that, they might lose. And so they may have to tell us what the likely loss will be. And because it hasn't happened yet, it won't be in the financial statements yet. So there's a lot of details that may not be recognised in the financial statements, but are still really important for decision making. So the auditor's report. So all reports have to contain this, the independent auditor's report. So it has to be a registered company auditor for the shareholder, and it has to state on an opinion on whether these financial statements are accurate, they conform with the accounting standards, and also there has to be some kind of opinion about the company's financial condition, right? Whether it's likely to be what we call a going concern. So if you are a shareholder in a company, you want to make sure that these financial reports are accurate because you have no other way of testing this. So the auditor comes in to check that everything's accurate. So they're saying these numbers are correct. You can trust the financial statements. So we'll be discussing this more in week 12, right? So a long way away, we'll be thinking about fraud and how to verify the financial statements. We'll look at different types of auditors' reports and different types of opinion. So at the moment, what you need to understand is the purpose of the auditor's report and how to read it. Okay, and recognise this final point here. It's not a report about the expected future financial success of a business. It's just saying, do we think it's a going concern? So is it going to continue in the future? Not how well it's going to continue in the future. All right, so the other thing we mentioned was management's discussion and analysis. So it's otherwise known as MD&A. And this goes more towards the front of the annual report. So it's usually in the first few pages. So it comes before the financial statements. And so it talks about the company's results, its ability to satisfy current obligations, and importantly for us, when we're modelling and forecasting later on, it talks about expansion plans. All right, so that's really important when we're trying to come up with a forecast. But we need to view this with a little bit of a critical eye, if you like, because this is like an advertising document for the firm, and usually they're going to show themselves in the most positive light, right? So they're going to put a positive spin on their operations. So they'll be highlighting all of the positive aspects of their performance. They probably won't discuss the negative aspects of their performance. And if they do, they will usually blame something else, right? So lately, that would likely be COVID, right? COVID-19. The poor results may be due to COVID or something else that's happened in the economy, while their good results are all about their fabulous management. So just be aware that usually it may be more skewed towards positive information here. Now, in a moment, we'll look at accounting regulation and framework. But before we do, I would like to now turn to the Woolworths annual report. So what I would like you to do is perhaps pause the lecture video here and download the Woolworths annual report, which I've put in the week 1 folder on iLearn. And I'd like you to please have that in front of you while we go through and have a look at various parts of that. All right, so you might like to do that now, and then we'll come back and look at that report. So I'm just going to download it now, and you can do the same. Sorry, let me just find that. I'll share it properly. There it is. Okay, so here it is, guys. Let's have a look at it. Now, when you first open it up, this is the annual report for 2020, right? And that is the most recent annual report. So in Australia, our financial year finishes on June the 30th. So you'll usually find that that is the end of the financial year in these Australian companies' reports. And then it takes a few months for it to actually be published. So a lot of annual reports, even though the ending date is June the 30th, often we don't see them published until September of that year. So the 2021 report is not published yet. So the 2020 annual report is the most recent one. All right, so when we start having a look at what's in the report, I'm just going to have a look at, maybe let's make that smaller so I can see two. Yeah, we'll see 2 pages at once here. So when we look at, you know, the contents page, notice they give you a lot of pictures. It's a nice glossy document. They have great looking diagrams through it and lots of smiling faces. Everyone's happy. So remember what I was saying before, that this is like some advertising. It's like a marketing document for the company. So they do want to show themselves in the most positive light. This report is given to investors or prospective investors. So they want to look attractive to these investors. Lots of graphics, lots of pictures here. Now, if we have a look at the contents here, you can see there's a lot of different sections. There's a lot of pages, right? So, you know, all the way up to page or even further, you know, it's about 150 pages here in this document. In fact, I might just make it smaller so we get it all in. Yeah, it's 151 pages there. So a lot to look at. And this can sometimes be a bit overwhelming, especially if this is your first time looking at annual reports. But we're just going to be focusing on certain parts of it. So don't be too intimidated by it. Just a bit of an overview here. So we were saying that normally in the first part, there are performance highlights, and you can see here the chairman's report and the CEO's report, sustainability highlights. So here are all the great things about the company, the things they've been doing well. And then in section 2, they're talking about their different segments. So they've got operations in Australia, New Zealand, so that's about food. Then they also own Big W, the big department store. They have Endeavour Group and other information there in section 2. Then section 3 is about their directors report. So all about introducing their board of directors and how much they're paying their directors, and you know how what mechanisms they have in place to make sure that all of their managers do the right thing. Then we come to section 4, which is our financial reports. Right, so you can see there's an auditor's independence declaration, financial report, director's declaration, and there's the auditor's report. So notice the financial report goes over many pages, like from page 75 to page 143. So most of those pages are the notes to the statements, and we're going to go to that and have a look. And then there's other information there. So I'd like to go to the financial report with you here. So I'm just clicking here. It's an interactive report here. So we can just click on the page 75, and that takes us to this page here, where you can see we have the table of contents for their financial statements and all of the notes. And just the page before that, we can see that this is the auditor's independence declaration. So it's not the auditor's report, but it's a declaration that the auditors are independent, that there's no association with the company, that there's no conflicts of interest with the company, so that we can trust their opinion about these reports. All right, so looking at the table of contents here, you can see we've got the profit or loss statement, other comprehensive income, statement of financial position, statement of changes in equity, and statement of cash flows. So there are the main ones that we've been looking at, followed by all of these notes. So you can see that, for example, if I wanted to know more about the property, plant and equipment, I would go to note 3.4, or more about the intangible assets, I'd go to 3.5, and so on. So these are all the notes that go with these statements. So let's just see how these match up with what we've been talking about. First of all, we have our statement of profit or loss here. In other words, the income statement. And you can see here that we have 2020, which is the shaded one, and the previous year, 2019. So we have comparative years here, and that's required by law that they have to do that. And if we have a look at the way they've set it out. Now, first of all, notice up the top that these figures are in millions, right? So they're really large figures. It's a big company. So we start with the revenue and we subtract the cost of sales, and that gives the gross profit. So you can see that they're using a multi-step approach here. Okay, so there's the gross profit on their sales, followed by other revenue, branch expenses, administration expenses. So they are their main expenses grouped in this way. As I mentioned to you before, different companies are going to have different groupings depending on what kind of expenses they have. And that then gives us the earnings before interest and tax, then less finance costs, which are interest, gives us profit before income tax, less the income tax expense gives us profit for the period from continuing operations. So that is the main figure that we would be interested in. It does have some discontinued operations, so they may have closed down a particular segment or subsidiary. And you can see that they did. That's what happened in 2019. So nothing like that has happened this year. But we're not really interested in that because that's not really part of their performance. Okay. Now, we're not going to worry too much about all of the other details here. Don't worry too much about that. You can see the basic earnings per share here, as we were discussing before. So that it is the profit from continuing operations is the one that we're most interested in. Okay. All right. Now, separately, we have a consolidated statement of other comprehensive income. And this is something we're not really going to be looking at closely. Basically, it's showing what else has happened that would have affected equity besides the profit, right? So we know profit gets added to retained earnings, but there may have been other events that may have affected equity as well. And some examples I can see here are, for example, a change in the fair value of investments in equity securities. So they've revalued their asset, and that, you know, if the asset went up, as it has shown here in 2020, then also the equity goes up. So these are just changes to equity that are separate to profit. But this statement is not something we're going to be using for modelling, so don't worry too much about that one. Okay, so let's have a look then at the balance sheet. So this is called the statement of financial position. And you can see here all of those subheadings that we mentioned before: current assets, non-current assets, current liabilities, non-current liabilities, equity. And in equity, you can see here's contributed equity, which is the same as share capital, right? And there's retained earnings. And this is something I briefly mentioned before, was reserves. So reserves are basically retained earnings as well, but it's just being transferred out of retained earnings into reserves for various reasons. So let's not worry too much about reserves. We're mainly interested in contributed equity and retained earnings. All right, and we've talked about most of these other items already. So I mentioned to you before about the notes to the statement. So see, there's this column that says notes. So if I, for example, wanted to know a bit more about their trade and other receivables, I would go to note 3.1. If I wanted to know about their property, plant and equipment, I would go to note 3.4. And all of those notes are listed on the pages after these statements. All right, so I mentioned to you before that we look up the top to see what's the scale. So if it's in millions and I'm looking at the total assets, I can see that that's actually 38,472 million. So I'd be adding 6 zeros after that. It's a huge figure, but it is important to note that scale, especially if we're comparing companies. Right, so next we have our statement of changes in equity. It's a big company, so you can see there are a lot of different things that have changed in the equity. Now, the total equity of 10,484 million here is the balance at the 30th of June 2019. So that should match what we have in our balance sheet. And notice if we look down the bottom of the balance sheet for 2019, that matches 10,484 and 10,484. Then it shows all of these different things that have happened to equity. So there was a change in share capital. They issued more shares. There was a change in their reserves, a change in their retained earnings. And all of those things have caused there to be a balance of 9,032. And this must match the balance at the bottom of the balance sheet for 2020. So we're just seeing the link there with the statement of changes in equity. And then we can go into our cash flow statement, right? The statement of cash flows. You can see the 3 areas of activity here: operating, investing, financing. Right, and importantly, we look at the bottom. Now, first of all, notice that they're using the direct method here, and that is usually what you're going to see. But then if we go to the notes, if we go to note 4.5, what we would normally see there is also the indirect method. So they usually show you both in the annual report. Okay, so that's the body of the report. But what's important is down the bottom where we look at the change in the cash balance. So as we saw in our example, it's got the change, the net increase or decrease in the cash. So in 2019, it was a decrease. In 2020, it was an increase. And then it reconciles the beginning balance with the ending balance. So you can see that 1,066 million was the cash balance at the end of 2019. That becomes the beginning balance, right, or the balance at the start of the period for 2020. And what we've just shown here is how we get to the ending balance, which is 2,068 million. Now, what we should be able to see is that those two balances match the balance sheet. So 1,066 for 2019, 2,068 for 2020. If I go back to the balance sheet, I look at the cash and cash equivalents, and there are those two balances. So we must understand those links because, as I said, when we're modelling later, we've got to make sure that they all match up. So the statement of changes in equity should match the total equity for the 2 years, and the cash flow statement balance should match the two balances of the cash in the balance sheet. Okay. All right, then we come to the notes. And the notes, as we noticed in the contents, go for many, many pages. It's very long, so we're not going to go through them, but you can have a look through yourself and just see the type of information that you get in there. You need to be confident with looking through this part of the annual report. And in fact, all the parts that I've been pointing out to you. So as I said, don't be put off or scared by the number of pages here. The more reports you look at, the more confident you get with this. And they all have a very similar format. Okay, so, you know, as we go on, we'll be focusing on certain parts and you will become more confident. So later on in the semester, we're going to have a case study where we'll look at the financial statements of a different company and you'll use it to do some analysis. So I want you to start getting confident with looking at these parts of the annual report. All right, so I'm going to go back now to the slides. All right, and we're up to this point here where we're just going to look at the regulatory environment for accounting, and first of all focusing on government regulations here. So this chart that we're seeing shows different types of government agencies that are involved in accounting regulation. So you can see here we have Federal Parliament and the Federal Treasurer. And if we look at Parliament, who enacts laws, they are in charge of corporations law and regulations. So we do have a Corporations Act, which Australian companies have to follow in their business operations. All right, and you'll learn more about that in other units, I'm sure. We're interested in the accounting regulation, and the Federal Treasurer is in charge of all of this. So you can see that there are two councils here, or two bodies that report back to the Federal Treasurer. So we have the Financial Reporting Council, or the FRC. And it is a government body here that is in charge of the standard setting boards. So we have in Australia a set of accounting standards, right, which is based on the International Financial Reporting Standards, and these are set by the Australian Accounting Standards Board. And we also have an Australian Auditing Standards Board, which regulates auditors. So both of those are in charge of setting the standards for relating to financial statements and relating to auditing, right? They are overseen by the Financial Reporting Council. So while this is a government body, this FRC, you'll notice that it is actually made up of different interest groups. So there are various interest groups that are represented on this Financial Reporting Council. So from business, from the public sector, and also regulators. So this helps to make it, you know, to give it a good oversight of whether these accounting standards are appropriate or not from the point of view of these different key stakeholders who are affected by those accounting standards. And in the setting of the accounting standards, so in the process, input from different stakeholders is encouraged as well, so that we get some standards that do represent the views of different interest groups. So these are the rules that have to be followed for accounting, for financial reporting. And the Australian Securities and Investment Commission, so this is the body that enforces the Corporations Act and also enforces the accounting and auditing standards. So if someone's found to breach any of these, the Corporations Act or the standards, then they will investigate and impose penalties. So you can see that there's a disciplinary board for auditors and liquidators, and also for general financial reporters. So that chart gives you an overview there of the organisations and committees and boards that are involved in regulation and accounting framework. And these are involved with government, but also note that there are some non-government bodies as well involved in regulation. So we have our two main accounting bodies here. The Certified Practicing Accountants of Australia, and also the Chartered Accountants. So accountants will normally become members of either one of these, and you may very well be in the future. So they are very highly regulated by the body, right? So any member of CPA or Chartered Accountants is regulated by the Accounting Professional and Ethical Standards Board, and there are very strict codes of conduct there. If those are breached, then there are various penalties that can be imposed. And also the Audit Quality Review Board. So that's specifically for auditors. So they provide regulation and penalties to members of these bodies. And really importantly, for publicly listed companies, and we're focusing on those here, for publicly listed companies, they'll be listed on the Australian Securities Exchange. And the Securities Exchange has its own listing rules, which regulate the companies that are listed. Now, the ASX is not a government body. It's actually an independent company. And in fact, it is itself listed on the stock exchange, which is really interesting. So ASIC, the Australian Securities and Investment Commission, the government body, oversees the Australian Stock Exchange, but the stock exchange regulates the companies that are listed there. All right, so interesting to see both government and non-government regulators. Now, what kind of regulation do we have? Well, in accounting, we have what are called generally accepted accounting principles, which is often abbreviated as GAAP. And we kind of use this term in a couple of different ways. So often we use this term to talk about the general principles that underlie a lot of our accounting practices. So, for example, we have a principle of conservatism in accounting, which means that we don't want to overstate assets and we don't want to understate liabilities. We don't want to overstate revenue. We don't want to understate expenses. So that is our principle of conservatism, and that will underlie a lot of the more specific rules that we find in our standards. So that's just one example of a generally accepted accounting principle. So that's a very broad term there. And then different countries are going to formalize those principles in their set of standards that they have to regulate companies. So in Australia, we follow the International Financial Reporting Standards, and I refer to that as IFRS. Right, so that's what people normally call it, IFRS, but that's for most countries in the world follow IFRS. In Australia, our Australian Accounting Standards Board actually modifies those to be tailored to our Australian conditions. In the US, they don't follow IFRS. They have their own set of accounting rules, and confusingly, they call those rules GAAP. So when you read something about GAAP, it might either be talking about the broad set of principles that all accountants follow, or it might be referring to US GAAP, which is the actual formal name that the US uses for their accounting standards. Now, there are some differences between the US standards and IFRS. All right, now generally the standards are the same, but there are just some minor differences here and there. There's a major difference in the way they're written, in that the US GAAP are what we call rules-based. So they look more like our tax laws. It says you must do this, and in this case, you must report it like that. Whereas under IFRS, it's what we call principles-based reporting, where there's a lot of flexibility. So there's a difference in the way they're written. There's some minor differences in the way that they want some items measured. So it can get, a little bit difficult, especially when you're looking at companies that are globalized and operating across different countries. But what we have seen lately is a little bit of convergence between the US rules and IFRS, which is good news, right? So in the US, it is starting to now accept the reports of companies that are prepared using IFRS. So as long as a company is following one set of rules, whether it's US GAAP or IFRS, it will be recognised in either jurisdiction. Okay, so that's actually good. So there's a bit of convergence and there's a bit of accepting the other countries' formats in these companies. So we're going to come back to that later. We'll talk about more specifics about the differences between US GAAP and the International Financial Reporting Standards. Okay, and there are some general principles and qualities. So we have what we call, under IFRS, we have the conceptual framework, which has some qualitative characteristics that all businesses have to follow. So the reports that they produce have to be relevant to the users. They have to be reliable, so they need to be accurate with no errors. They need to be comparable to other businesses, and they need to be consistent over time. Right, so important principles that need to be followed in these reports. So we've just looked at that very briefly, and we'll go into more detail about that later on. So just to finish off here, I just want to talk about main types of business organisation to be aware of. So 3 main types of business structure that we have in Australia. And quite often a business will flow through these 3 stages as it becomes, as it grows and becomes more successful. So a business might start off as a proprietorship or a sole trader. So this is normally, if you have a great business idea, then you might just set this up on your own. You would be the owner and you would also be the manager. So if you look at small businesses, maybe like your local hairdresser, for example, that would be a great example of a sole trader. So it might be a small retailer or a service provider, or maybe an accountant, right, who's working on their own, so an individual professional business. But an important feature of a sole trader is this concept of unlimited liability, right? So what this means is that if this business is trading, and let's say it takes out a bank loan, and the business is not going so well, so it's not able to make its repayments on that bank loan. This concept of unlimited liability means that the owner is personally responsible for settling that bank loan. So that might mean that the owner has to sell their personal assets. They may have to sell their house or sell their car to pay that business debt, right? Or if someone walks into their shop, falls over, breaks their leg, sues the business, then it is the owner who will be personally responsible. So in the eyes of the law, the owner is an extension of the business. If the business can't pay, the owner has to pay. And there's no limit to that. So that's why it's called unlimited liability. So it's a major disadvantage of being a sole trader. There's no protection. And it's the same with partnerships. So if we think about a partnership, so you have two or more co-owners. So it might be a business that started as a sole trader, and then that owner brought in, some partners, and they all become co-owners. So they all share in the profit. They may share the management of the business. So it still could be quite a small business, but it could also be quite large. So if we think about our big four accounting firms and big law firms, so big professional organizations, they are also set up as partnerships, but they're huge. And so they often have different levels of partners. So they might have the senior partners, the junior partners, the associates, with different levels of responsibility. So it is very similar to a sole trader, right, in that there is unlimited liability. So the partners are seen as an extension of the business. In the eyes of the law, they are the same as the business. So the owners are personally responsible for settling the debts of the firm. And it's even a little bit worse with a partnership, because if one partner makes a bad decision, right, and it causes a big loss, then all of the partners are personally responsible for the consequences of that bad decision. So if you were to go into a partnership, you would have to be very careful that you're going into business with the right people. Okay, so sole traders and partnerships have that major disadvantage of unlimited liability. But the company structure is different. So with a company structure, in the eyes of the law, they are seen as a separate legal entity. And as we said before, the owners are the shareholders. Now, because the company is seen as a separate legal entity, it means that if the company takes out debt, or if someone sues the company, it is the company that is responsible, not the owners. So the owners, who are the shareholders, will never be asked to pay more than they have invested in the company, right? They'll never have to pay more than what they paid for their share. So if you bought shares in, let me think of a small company. So let's say you bought shares in Harvey Norman, right? So Harvey Norman is a company that has suffered a little bit in COVID. And let's say that company went bankrupt. You own shares in it, right? Now, the bank is going to be wanting their money back, right, from Harvey Norman, but the bank will not come and knock on your door as the shareholder, because you have already paid for your shares. You don't have to pay any more. So you are not personally liable. So that makes a company structure really attractive, because it does protect the owners from liability if something bad happens in the company. But the downside of that company structure is the strict rules that they have to follow, right? As it says in this last point. So companies have to follow those accounting standards, which are very strict. And that means paying accountants to file their reports every year. If they're listed on the stock exchange, there are all of those extra listing rules as well. So there is a lot of expense involved in not only setting up a company, but also the ongoing running costs of the company, the accounting and the legal costs and so on. So there are advantages and disadvantages to each of these forms of business structure. Normally, as I said, we see businesses grow from being a sole trader to a partnership to a company, but it would have to reach a certain level of performance to be able to justify those high costs. If it's just a medium-sized business, it normally would not be able to justify these high costs involved in setting up as a company. All right, guys, so that finishes the topic. Now, just a couple of things to think about here. So I have put up that introduction video that takes you through the structure of the unit and the way we're going to use iLearn. So if you haven't already, please look at that introduction video that I've placed in the unit resources part. Unit information and resources part of iLearn. So the video link is there. Each week you're going to be listening to the lecture recording as we've done here, but you'll also notice in the week 1 folder that you have access to now that there is the practice quiz that you can try after you've gone through the lecture, after you've looked through the Woolworths annual report and become familiar with it. You can try the practice quiz, which has questions that are coming from Peerwise. So try that, but also there are other activities as well in that week 1 folder that are useful for you to get to know the financial statements. It's got a couple of companies there, so you can practice looking up their reports and answering some questions about them. So that is all there for you to do. Now, I'll just make the point again, this is in the introduction lecture as well, but everything you're seeing on these lecture slides each week is what is going to be covered in the exam. So in other words, everything you need is on the lecture slides and in the lecture recording. Anything that's not in the lecture slides or the recording, you don't need to know. Right? So that just gives you some guidance. But I would also highly recommend that you get the textbook as well, because the textbook gives you extra descriptions and extra examples. So for example, for our topic today, you would look at chapter 1 in the textbook, and the textbook details are on the unit guide and also on iLearn. So in chapter 1, you'll look at the balance sheet. It tells you a bit more about it. It gives you more examples. When we start doing our topics that involve using Excel, the textbook also gives you more examples for you to practice using Excel. So it's a really good resource for you to invest in. So I've given you the link there for both the print copy and the e-text. The e-text is much cheaper, but that's there on iLearn in the unit information and resources as well. So I'd recommend you get that textbook. I've also recommended a text that targets your Excel skills. So many of you are going to go into a career as an accountant or an analyst or in finance in some way, and that means you will be using Excel a lot. So the second text that's listed in the unit guide is also really useful, and the library allows you access to that one. But you may choose to buy it as well, because the access the library gives you is only temporary and you can't download it, you can't print it. Okay, so that's the textbooks. I'm just thinking about other things that I want to point you towards. Okay, the other thing I wanted to remind you of is PeerWise. So I talk about that in the introduction video. You've got a lot of information there on iLearn in the unit information and resources. So please register for PeerWise and follow the instructions to do that registration, join that community, write some questions, earn some badges, be in the running to win a prize at the end of the semester for your interaction and your contributions. And the more questions that you can write on there, the more everybody gets to practice. So the questions on PeerWise should hopefully be really helpful. And some of those questions are going to be on the final exam. So I'm going to be choosing questions written by you to go on the final exam. The more practice you do, the better you're going to do on that exam as well. All right, everybody. And one more thing I'll remind you of is the consultation. So my consultation details are there as well. So please feel free to drop in. The Zoom link is there on iLearn. So come and see me, come and say hello, come for 5 minutes, come for 20 minutes, whatever you'd like to do. Have some questions ready to ask me after you've gone through the materials. Okay, everyone. So finishing off there, thank you very much for joining me, and I look forward to working with you throughout the session. Thanks, guys. I'll see you in the next one.